Let's talk about volatility and how it affects our option prices. I want to share a number of things as it relates to volatility that I think will help make you a better trader. In basic terms, volatility is the degree of movement of price over a specific period of time. For example, let's say a stock over a week is moving up and down a quarter, 25 cents, no more than that each day. However, the next week, it's moving up and down $1 or $2 each day. That volatility is much greater the second week than the previous week when it was only moving about 25 cents. You can look at volatility a number of ways. You can compare it to other similar stocks in the same sector or compared to the market as a whole. Does it have larger price fluctuations or lower price fluctuations compared to the rest of the market? When you see how much it costs for a specific options contract, it's good to know that there are three parts that make up that premium. The first part is the underlying value of the asset. The second part is the expiration. How much time is left on that contract until it expires? And the third part is today's topic, volatility. You may have seen or heard the term implied volatility. Now, this represents the market's forecast. How does the market think this security is going to do moving forward? If the implied volatility is moving up, well, then the market is bearish. If the implied volatility is going down, well, the market is bullish. And historical volatility is exactly that, the fluctuation of an asset such as SPY over a specific period of time. Related specifically to volatility and the SPY, you may have heard of the VIX, V-I-X, often referred to as the fear index. And what it does, it's a measure of future fluctuations of the SPY over 30 days. At SPY tomorrow, when we're doing our overnight swing trade, it's good to know which direction volatility is going. If it's going up, premiums could be going up, which could be in your favor by morning. However, if premiums are coming down quickly, well, that could be a disservice to you because even if the indicator is right, you could still lose money or not make as much as you thought you might. Volatility is pretty much a result of supply and demand, greed and fear. And when we're coming up to big news events or earnings, quite often the supply and demand, especially the demand, increases, which means volatility increases, increasing the premiums. However, a lot of times after the news or after the earnings, you'll notice that that volatility comes down quickly. And that can result in what is referred to as an IV crush. And oh, those are painful. This is why I like to focus on a few very specific ETFs or stocks. You get to know where the premiums should be. If you're always searching for a new stock, you don't always know where the usual premiums are. And so you could fall for an IV crush very easily when news is around the corner. However, if you see SPY day in and day out, or Apple or QQQ day in and day out, you know that the premiums have been jacked up and it just might not be a good time to trade. Change in volatility, well, it's certainly broken an algorithm or two over at SPY tomorrow. And over time, we've learned to adjust by switching algorithms based on the volatility level. Different algorithms for high volatility as well as low volatility. We even have a tool for members that measures the volatility and then recommends specific SPY-T trades for that market. Understanding volatility can help you make better decisions before you buy your options at the end of the trading day for your overnight swing trade. And when you understand how this volatility is impacting the options you're buying, it makes you a better trader. Make better decisions, avoid those IV crushes, and I'll see you in the next video.